Good afternoon, good evening, and even in some cases, good morning. My name is Jared Carney, and welcome to a panel entitled Macro Uncertainty, Examining Economic Growth for 2020 and Beyond. I am a venture partner with Spark Labs Group and investor with them in a few projects and a big fan of the organization. And what we've been doing timely now is convening panels with experts from a variety of fields to fuel the information flow and curiosity of global investors. And I think that today's panel is no exception from in terms of its relevance, and we have an esteemed duo who I think will take us through a great number of big picture items, but also make them relevant to us in terms of our daily work as investors. We are honored to have us joined by Professor Lars Hensen. Professor Hensen is the David Rockefeller Distinguished Service Professor at the University of Chicago, and he may be best known to many people viewing the panel as the 2013 recipient of the Nobel Prize in Economics. His work is best known for really kind of bridging and connecting macroeconomics and statistics, which makes him unique in the field. And he examines the links between the financial sector and macroeconomics. He presently works out of the Becker-Friedman Institute at the University of Chicago, an organization that is near and dear to my heart, because it was my great honor to work with Professor Gary Becker when he was still alive and when I was at the Milken Institute, and have a great deal of affection and esteem for that organization. Presently, Professor Hensen is focusing much of his time on doing research around the pricing of macroeconomic shocks to the alternative investment field and the implications to long-term uncertainty of those shocks. We also will get into a robust conversation about so-called ESG or green investing and other areas. His extremely estimable colleague on the panel is my good friend, Tom Lee. Tom is the co-founder and head of research of Fundstrat, a equity research company based in New York City with a global remit. They're best known really for looking at thematics, and that's quite unique in his field, and cycles. He's very well known before he started his company from having been the chief equity strategist of JP Morgan. Tom's career has really been defined and has been made very unique by his desire to understand the mechanisms and forces underlying all financial markets. And so, it's with his incredible background and successful background as either, I think, Tom, you were either number 1, 2, or 3 ranked by Institutional Investor for 13 years straight. So I think we're very, very excited to have two people who come from different perspectives, but I think can illuminate a great deal of what is going on and perhaps what is not going on, and maybe even just share more questions with us that we should be thinking about as market actors. With that, I'd like to turn to you, Lars, and really ask you to frame the conversation for us in how would you have us conceptualize and model uncertainty in what are certainly very uncertain times?
Yeah. Well, thank you for the invitation for this panel and for allowing me to participate and share some ideas and thoughts and exchange views. My thinking about this is influenced by ideas that go way back. You can find these ideas certainly in Frank Knight, who is a pillar of Chicago economics many decades ago. You can find it in some of the early writings of John Maynard Keynes as well. They were wrestling with this notion that uncertainty should be broadly conceived and not just narrowly conceived. Whereas the type of uncertainty we teach in economics classes typically has to do with the notion that, well, we don't know outcomes, but we know probabilities. It's just like when we flip coins, we roll dice, which we don't know outcomes. And that kind of frames a lot of the discussion of risk premium, of risk aversion, and the like. But in a lot of settings, this really, I think, understates the type of uncertainties we face. People inside markets, people outside markets, external researchers, we're not really sure of what the right model is going forward of say macroeconomic growth. We're uncertain about what that model is. We may have multiple models that we entertain, multiple views we entertain more broadly. Moreover, anytime that we're writing down models and conceptualizing them, they're simplifications, they're approximations, they're wrong. So to pretend those models, even though they may be mathematically elegant, give us the exactly correct probabilities, it seems to be just an incredible stretch. So a lot of what I've been interested in is how can we use multiple models sensibly and not discard them. I think they're very, very useful, but not overuse them, not take them too literally. And this plays into this idea of trying to think about uncertainty in the most broadest of terms.
So how then do so many people viewing this panel and listening to this panel who have backgrounds, say business school backgrounds, what do we do with the sort of the model orientation that we've been educated under? You're not just a macroeconomist, you're also a statistician. Do we have the right educational backgrounds to even begin to approach this?
So sure, I think absolutely. I'm a firm believer in the use of mathematical models. I do it all the time. I'm a firm believer in the use of statistical methods. They're kind of key to things. And so it's more to the issue of how we use them. And I think sensible decision makers are already doing this. They say, well, give me this precise model and you can tell me the outcomes, but how might it be not quite correct? Or maybe it's this model instead of this model. I think, even at an intuitive level, I think smart decision makers are kind of doing this. And part of what we're about is kind of fully conceptualize is to turn this into a modeling tool and framework and formalize the whole idea. And so basically what you want to be thinking about is, first of all, I like this quote from St. Thomas Aquinas, beware the person of one book. Well, I say beware the person of one model. It's like in a lot of phenomenon, we don't, to go all in on one model might be an expression of just incredible confidence, but it's false confidence. It's just not, it just doesn't reflect our knowledge base. And at the same time, we want to think about these models as kind of not quite right, but you can still use mathematical and statistical tools by saying, feeding them through models and saying, well, if it's wrong in this way, what happens? Does this matter? If it's wrong in this way, does it matter? Or what are the possible mistakes or what are the possible ambiguities we face that really matter for decision making? And so that still uses mathematical tools. It uses statistical tools to bound things, to put credible bounds on things. As well. If we just give up on all probability and statistics and say everything's uncertain, then we're led to not doing anything. So yes, you do want to use those same tools you've been exposed to in education. And as I say, I think smart users of models do this at an intuitive level anyway.
Mm-hmm. Thank you. Tom, you're renowned for being a smart guy and for being as good as anyone, if not better, in terms of understanding the equity markets. How do you avoid in your work, and how do you avoid the tyranny of one book, one model? And how do you think about trying to apprehend for many what is the unapprehendable?
Yeah, foremost, I would 100% agree, because, if there was one model or one book that worked, we'd all be using it and we'd all be, fabulously rich or all broke. Because the person who sold the book made all the money. So so I think, in my career, I've done many things, even though I've always been in research. I did wireless. So I did tech stock research from the 90s when wireless only had 34 million customers. Today it's 5 billion. So, I followed an industry that had almost 1,000x growth in size, and how people judged good or bad companies changed in that 25-year period. Because, they didn't make money, and they were borrowing money and funding in the high yield market via Drexel in the beginning. And then now they're all huge cash flow companies that make more money than cable companies and telecoms combined. I mean, look at Apple, it's the biggest company. So, so I think if someone was trying to employ a single model to value wireless for that 30-year period, they would have either sold it, 24 months into it, or they never would have bought because of the uncertainty of the future. So I 100% agree. You can't quantify in a single outcome when you're investing. And so our research process, I think, recognizes that. But we're also aware that clients actually have a singular outcome. The only thing that matters to clients is the performance of their portfolio. So they have a single metric, but the way for them to derive the best return is completely uncertain. So I might say, I think what Lars is saying 100% resonates with me.
So, Lars, to go to Tom's point, though, are models more oriented towards outcomes and not probabilities? To your point about we can get our hands around probabilities, but not outcomes. So are investors looking for and do they have an unreasonable demand on models?
If I write down some mathematical model with all this evidence and everything, and I take the predictions of that single model as literally in terms of designing course of action without asking about how it might be flawed, then yes, there's potential mistakes being made there. At least I think. I think you're living dangerously. You might be lucky in the short run, but sooner or later the model's going to fail you. And so I think you have to take a little bit more cautious look at some of the models. I don't think you ought to discard them. I think you ought to use them sensibly. And the key here is, yes, there are decisions which we want to be taking. There is some type of, yes, maybe I want to, if I'm a society, I might want to take particular views on how to confront climate change. If I'm an investor, I might want to focus on what the behavior of returns are. But you can still have these broad notions of uncertainty feed into that decision making, and so the type of tools we've seen before can be extended in these very useful, and I believe very useful ways.
Yeah, I mean, so it kind of leads to my next question, which is really, what are the most important sources of uncertainty of economic growth or to economic growth? Because obviously those sources inform decisions, yeah. To use your point. So, how would you frame that out and enumerate those?
So that's very interesting in the sense of uncertainty for macroeconomic growth has this notion of, just like interest rates compound, uncertainty compounds. Mm. And so as you look at macroeconomic growth further and further out, that uncertainty can get bigger and bigger and larger. And so I for one didn't forecast this pandemic, but this pandemic happened. I have to entertain the possibility that these might occur in the future. Lots of my economic colleagues, say, "Oh, well, I predicted the financial crisis that we had previously." Well, most of them may have said qualitative statements and given qualitative warnings, but the magnitude and timing they most likely missed. So so there's so what uncertainties should we expect in the future? So I think the issue about the human consequences on the climate is a situation where there's substantial uncertainty as it plays out in the future. And some people say, well, since it's uncertain, we should just wait and not do anything until we get certainty. And the thing about decision making on uncertainty is that's often not the correct perspective. Just the possibility of potential bad outcomes can make it smart to be taking actions now. Or then look at the COVID, which we've seen. If you track some of the earlier mathematical models of the implications of COVID, you'll see people talk about the model outputs, and some of the discussions are about here's the best guess, and some of the discussions are about, well, here's what might happen. And both of those calculations are interesting, and how you trade those off is, very, very important part of decision making. But it's also important to distinguish those two. What's my best guess versus what I think could happen? And models can provide answers to both of those. Now, what are the important macroeconomic uncertainties? Of course, we can talk about technological growth. There's debates over how that's going to play out in the future. When's the next pandemic going to hit? Will it be the same severity, or have we really learned to cope with the next one? How will climate change unfold? I mean, these are just examples.
So, Tom, we just got two big chunks there from Lars to think about that are obviously on our minds today, and also what we're thinking about for tomorrow as investors. I'm going to flip the order that he gave those to us and start with COVID. How are you really breaking down COVID factors as a researcher and as a markets guy?
Yeah. Well, COVID is without question the single biggest factor in markets this year, because, if you had to say, let's pretend 2020 didn't happen, but we'd say, what would cause the Fed to introduce a completely new playbook, which is, low forever, and would cause the US government to pass $5 trillion of stimulus, and what could cause the global economy to shut down almost completely within a matter of days? I think before 2020, we would have probably said like an alien invasion or a meteor hits, but we would have said it was an improbable event, and it's happening. So, I think that undoubtedly the path of this disease and how we react to it from a policy and the individual's response and our future sort of shifts in how we will behave and how businesses move capital. I mean, it's all linked to COVID-19. So it's huge, and yet it is completely uncertain. I mean, I think, what has been central to our work this year for our clients is the recognition of that nobody knows the future. I even, there are several very well-regarded healthcare models out there, forecasters from IHME to Imperial College, and we did a webinar with Charles Murray last week on this, and he had a chart showing the sort of the relative statistical standard errors of these models over 10 weeks. And one of the most well-known ones was off by 600%. And that was Imperial College. And so you can imagine policymakers made decisions based on the views of these experts, and they were off by like a country mile, actually a galactic mile. So, so we've been, we've actually made we've recognized you cannot forecast what's happening with COVID. So the only thing we can track is the cadence of the data. So if things are improving or getting worse, but beyond that, we just don't know what people are going to do. So I think the uncertainty has been central to our process, but I think it's also really helped clients, because if you know what's uncertain, then you also know what's very certain. And I think that those are the certainties are what we focused on. And I think those are the reasons we were able to help our clients this year.
Can you give some examples of that?
Yes. So there are some things that are quite curious that we had observed as certainties in March that someone might say is, blatantly crazy, but there were two observations we made. The first is that when markets fall, the recovery is symmetric. So there's actually symmetry into sell-offs, because most people think, oh, you fall 30% or 20% over whatever period of time. They always say something like, well, it takes 18 months to recover to your highs. Or they'll say like, hey, you have a recession, it takes, well, what we had really demonstrated was that earnings actually are symmetric to their decline, because companies, whatever circumstance caused it to decline, companies dynamically respond and they cut costs. So actually earnings recoveries typically are V-shaped. Mm-hmm. And as a consequence, stock market recoveries tend to be very symmetric to their decline. And so if history was correct, so we were using 100 years of comparisons, we would have recovered half of the losses by April 15th, roughly by mid-April, and markets would have made new highs sometime between August and September. And so that was a crazy observation, but that's literally based on the symmetry of markets. And of course, the second is that, central banks, when the Fed is really providing a level of communication you cannot expect, it pretty much subverts anyone's earnings per share model and its effect on stock prices. So those were the two certainties that we had, even knowing that COVID was completely uncertain.
So Lars, before we start to unpack your climate change source of uncertainty, I want to go back to something Tom just brought up, which is the Fed. I'd be remiss if I didn't ask you as a macroeconomist about your view on the Fed's response and central banks around the world's response to COVID-19 coronavirus, and whether you think that we're not necessarily opening up a whole Pandora's box in the medium and long term here with the stimulus that's been shared and given to so many.
So yeah, that's a terrific question. I really have often been concerned about the notion that we somehow think about monetary policy in isolation. I really think you cannot really think about monetary policy without the interactions with going on with fiscal policy. And for a lot of purposes, like even going through the financial crisis, I think there's far too much attention on monetary policy per se versus financial market oversight and the like. The monetary policy in the financial crisis worked well initially once it was identified by the provision of liquidity. After that, the successes were, even though they're declared firmly, were kind of far more ambiguous. But on any of these problems, COVID as well, this is really an issue about fiscal as well as monetary challenges going forward. And from the fiscal side, we were really over a barrel here. We had to do something to help out huge chunks of population that are now suffering potential job loss and other hardships. On the other hand, countries like the US went into this in not a very strong position as far as deficits and debts go. So we're going to have to play a very long game going forward coming out of this stuff. And if we just think about monetary policy as somehow the solution, it's just not going to be. We're going to have some very important fiscal challenges and the like. And I see monetary policy authorities in the US at least are trying to give themselves even more wiggle room going forward and be less clear in their signals going forward. In times of crisis, I like to give them wiggle room, but I hope that they escape it sometime soon. And so I'm of course, I have some concerns about how we're going to get out of this. We've got ourselves into some pretty substantial financial challenges going forward. I think they were forced on us. We had to do some stuff. And so hopefully we'll be smart coming out of them and not just kick the problems down the road.
We can get into a whole other conversation about kicking the problems down the road in terms of synchronization or at least collaboration between monetary policy and fiscal policy. But Tom, as an investor and an advisor to investors, at least in the public markets, has this has this this stimulus actually been a source of, in a strange way, certainty in uncertain times? And has it allowed you to make better calls on industries and companies?
Well, the stimulus certainly affected markets because it put money in consumers' pockets, and we saw significant effects because some small businesses or companies that collected a large share of those stimulus dollars reported great numbers. But as you know, if you're paying 15 times earnings for a company, you're paying for 60 quarters of earnings. So if stimulus is just helping 1 or 2 quarters, that's just it's really a flash in the pan. It really doesn't change trajectory. So I think the companies that have really done well in this crisis are the ones that are seen as structurally advantaged by the crisis, whether it's work from home or those that respond, that are in front of this change in behavior, like, home offices and furnishing, and look at restoration hardware and Tempur-Pedic and how demand has just exploded for mattresses. And so I guess that's the answer. I think the stimulus is clearly necessary because, there's massive suffering and unemployment. But if anything, 2020 just really highlighted there's the economy and this fiscal stimulus for the economy, but the stock market is a different cohort completely.
Absolutely. So when you think about that cohort and Lars's other large source of uncertainty, climate and climate change. Some have argued that this is as much a climate crisis as it is a health crisis, and we can get into that in other times in other settings. But when you think about climate sources of uncertainty, what are some discrete factors that you enumerate? Do you believe that they are in fact sources of short and long-term uncertainty?
This question's for whom?
Tom. That was Tom. That was to Tom.
Well, from a ESG as a category is important to investors, but it's not necessarily driven by stewardship of the world or benevolence. It's that there are real allocated dollars for ESG, and some funds have ESG mandates, and because of those mandates, some stocks will be added to benchmarks and they benefit. So it affects corporate behavior as well. It's kind of growing as a topic, but maybe it's just because we do macro and we're not ESG focused. It's in our conversations over the past 6 months, climate effects of this pandemic and the shutdown. Everything from, reduced air pollution or, governance, none of these have been as central to our conversations. But again, it could be very important how markets are looking at it, but it's because of the lens that people work with us on, it hasn't been central.
So Lars, is this an example of the wrong policy framework, sort of not creating good enough incentives?
So it's very interesting. If I think about this pandemic and compare it to climate change, this pandemic played out over a very short time period in a very dramatic fashion. So we're thinking about what happens over weeks and months and the like. Climate change, we're thinking about happening over many years and decades and the like. And so it really is playing out at a completely different time scale. If I think about the uncertainties, there's kind of 2 parts to this. And one is from a societal standpoint and one is from a market standpoint. So let me talk about the societal standpoint first. So here's where there's multiple types of considerations that come into play. First of all, if you look at evidence from geosciences, you see lots of evidence for human input on the climate. But if you quantify that through, you'll see lots of differences across models and model predictions. You'll see substantial heterogeneity in the quantitative magnitudes and timing and the like. And so it's not, so once you try to quantify how it's going to play out, that's where the uncertainties come into play. From the geologic, from the purely kind of geoscientific side of things. That's where the key uncertainties are. But then, say that translates into temperature changes. Temperature changes are going to affect economic opportunities. Okay, so now economic uncertainties come into play. People are going to face climate change. They're going to adapt. They're going to make modifications. It's going to be costly, but how big are those costs? Environmental economists make up these so-called damage functions. They're just very simplistic constructs to capture something that's very, very much more complicated in nature that we need to understand better. And so these two types of uncertainties interact and even reinforce each other because of their connections. And we often think of ourselves in a data-rich environment, but we're talking about moving the world into places we haven't really seen before. So you can't just look at data and hope that everything's revealed. We can't just postpone it, because if we postpone it too long, the cost of addressing climate change may become just enormous. So it's a case where we really have to face up to decision-making under uncertainty. And the policy challenge here is the fact that the social cost of these emissions and the private cost of these emissions are different. This is what economists like to call externalities. Yeah. This is the simplistic economist approach to these is Pigouvian taxes, so-called carbon taxes, which I think are probably politically naive, in spite of some of their economic merits. But those are the type of uncertainties that society faces in trying to address sensible approaches to climate change, in terms of how much do we subsidize green technology, how do we kind of nurture a transition from the current one to one that's more green and the like. That faces these important uncertainties. Now, how about markets? Yeah. If I look at the evidence that I've seen about uncertainty, what people will do in the academic literature is I'll go do and look at newspaper tabulations of climate uncertainty and other sources of uncertainty. If you open the hood of those, a lot of those are not about these fundamental uncertainties I talked about. It's about what's the policy uncertainty. And markets are the types of uncertainties that markets face in the short run related to climate has to do with speculations about what changes in policy are going to be made. I have had a former student of mine do this research on a so-called carbon bubble. Imagine that you're sitting on a stock of this a stock of oil, and you're fearful of some type of policy change down the road. Maybe you exploit a lot more of it now, or drill a lot more of it now in order to anticipate some clamping down on the government going forward. I mean, those type of responses the private sector is going to naturally want to make, just based on the possibility of types of government interventions. And so I think from a private market standpoint, that these policy uncertainties related to climate change, at least in the short run, are even more important than the more fundamental ones, which I talked about initially.
Tom, does that coincide with your skepticism of ESG as an investing style right now? That, the policy incentives or drivers, right, in the short term just don't seem adequate to really and matched with the externalities, as Lars is saying. Many economists have sort of diagnosed that coincide with the climate change.
Yes, and I guess skepticism's maybe not the best word, but
not enthusiastic.
Yeah, yeah, it's hard to make the linkage, and I guess because Lars made a great point about how from a policy, when you look at it from how policy flows through, and how it affects capital allocation. But I think, a simple way to think about it is financial markets are equity and bonds, and they're issued by, large companies across the world. But, of course, most of the market cap today now is US companies. And the US companies have a board of directors that pay their CEO. And CEOs are among the most highly paid people in the world. The average annual compensation is now well over 20 million a year. And, but they're paid on metrics like EBITDA, stock price appreciation, KPIs, like key performance metrics. And again, it's an outcome focused metric, because what CEOs are paid on basically is what makes shareholders happy. And shareholders today are, have a time horizon that at most is 3 months, because it's their next quarter end. Right. So unless you have a series of milestones related to climate that are measured in intervals of 3 months, it's not going to matter. And then it's like a bullet payment, it's like then all of a sudden the amplitude is a billion because it suddenly matters. And I think I think it's a real challenge, because, how do you, maybe you have to create a futures market that is policy compliant, and then you can hedge against that, and you can pay for not being compliant. And that's how you fund your lack of compliance. You know what I mean? So
we've done it in other areas. Sure.
Yeah. So that could be the future, that you create a policy compliance futures market, and you can do it by industry, and people can buy and sell it. And then it matters, because then all of a sudden GE,
that's a University of Chicago.
We got $100 billion. We're short this contract by 100 billion. We better do something, or else we're going to be, it's like a CDS.
Well, yeah, that's a very interesting idea. And like I said, near and dear to University of Chicago.
Yes, of course. And someone like Professor Hensen would figure that out, because, as they say, equities are the land of sea students.
So at least a B+, Tom. So the other pillar of uncertainty that Lars identified is tech. It's important to this conversation because for many people, tech is really synonymous with innovation. And I guess the first question I have for you both is, do you agree with that? Do you agree that investing in tech and a focus on technology by the markets is synonymous with innovation? And I'll actually go to the second question after that. Tom, I want you to answer that one first, please.
Yes. We could have a whole 1 hour, maybe even 20-hour panel just on that single question, because, I think it's central to explaining the last, maybe 60 years of financial market relative performance. I guess my first answer is, if I had to make a broad brush definition, technology is it's not defined as a service or product, because, as you know, in the 1950s, there was no such thing as web-based providers or CRM systems. So technology back then was really a product that replaced a way to create output using a legacy method, right? So, I guess when someone made a spoon for the first time, that's technology too. Like, that was a fintech story, like the first coin. But then what that means is, technology actually is born out of necessity. So it's really when the unit cost of the traditional system gets expensive, then it creates demand for technology. And then the technology is quite valuable until the cost of that technology doesn't pay for itself, or too many people provide that technology service, and then you have overinvested capital. So to me, that's the cycle that explains tech. And you know, a simple series we show for our clients is that, like, let's say you start in 1930 and you take it all the way to today and you say, plot this difference between total population growth in the US and the number of people of working age. Okay, so you do the spread. And it's very cyclical. So there's 3 periods where US had population growth surpass the supply of workers. The first one's like 48 to 67. And then the second one was 1990 to 99. And the third one started in 2015 and is actually continuing. And what's interesting is that those are 3 periods where labor shortage is actually structural, because there's actually, you know, your units of population is growing fast, but it's going to then mean the people who are in the labor force that capture value. So I'm not talking about the total labor force, but the people who add value, they're actually in short supply. So it creates wage inflation for the skilled worker. Like, that's what's been happening with tech workers now. And interestingly, in healthcare workers, but in those 3 times, technology stocks went parabolic relative to the S&P. So to me, technology is really simply explained as, in the last 80 years, the most valuable technology developed are the ones that replace expensive workers.
Lars, is this a question of labor economics at the end of the day when we see the impact of technology on markets, or is there something bigger afoot here?
There's no doubt that technology advances affect labor markets. They affected, you know, what sort of skills are demanded by you know, once you make a technological advance, what sort of skills are required? Does it make the skills of some segments of the population obsolete? It puts a real reward on people who get broad set of skills that can be adaptable to new technology. So there's absolutely kind of a labor market component to this. More generally, I think of innovation is an interesting challenge. It's kind of like, yes, innovation might occur within existing tech firms, in which case, you know, equity markets might have something to do with it. But then a lot of innovation may come in from other sources too. And the real issue is, how do we get the funding to the people with the ideas? And that can come through a variety of sources. I think some of the promising innovations of, say, so-called fintech have to do with the fact that it can open the door to funding more kind of potentially, ideas of people who don't have access to financial resources otherwise. And of course, this is kind of what venture capitalism is about too. So I think innovation, how do we structure the right incentives and the right ways to get financing to the people with the really creative ideas? And that's a very important, that innovation is a very important engine of economic growth, and doing that in sensible ways and figuring out ways to do it is interesting. And what's fascinating is when things like fintech interact with this idea of getting finance, helping to get finance to new ideas.
So the challenge traditionally in that area has been that the parabolic nature of the markets that Tom described, right? That there's kind of an exclusion effect that happens, right? And so I think a lot of people are looking to technology and innovation right now to be a savior. I mean, it's not just widgets, it's also vaccines. It's also drugs. So, I guess, is there more of a, are we lacking because we don't have enough enlightened thinking about technology at policymaking levels, or is this one area where we would be very, very mistaken to try to have to try to engineer the invisible hand in any way at all?
So, I mean, the invisible hand could work quite well, for sure. I think the question you're asking is, do we want governments to subsidize innovation or something? Or some type of program to design it? So in some places, the answer might be yes. So if we really believe in the climate change externality, then you may well want to put subsidies into innovations related to green technologies. What you want to do is avoid investing in, have the government invest in clearly unproductive ventures related to green technology, which it's perfectly capable of doing. We all have plenty of examples of missteps by governments, but that there will be scopes and places where these externalities. And innovation more generally can be an externality because it can kind of really, in terms of how it interacts with economic growth. So there can be a case there to try to, this is probably the case for subsidizing education more broadly to open the door to more innovation and the like, and more innovative, and make people better able to deploy their creative talents. So I think there is some scope there for government policy. Anytime you open the door for government policy, you also open the door to abuses as well. It's very easy for governments to waste tons of money in unproductive causes. But I do think there's potential scope there for sure.
Tom, do you think markets would reward that type of?
Yes and no. I mean, yes, in the long run. I mean, I think the stock market does make good decisions in the long run. If we go back 20 years and look at some of the highly valued stocks, let's say that, 2 out of the top 5 are still top 5, okay? Here's what's amazing about that. That means the stock market made a 20-year decision and got 40% of the outcomes right. I mean, as you know, you ask a venture capital what % of your decisions are successful. I'd say venture capital does really well if only 1% of their decisions are correct. And if you take an active manager and you said, okay, well, you can be 40% right, but if those 40% offer monster returns, you can get the other 60% could be zeros. I mean, so the stock market's done a great job of self-selecting. But right, so if it does become important for the society perspective and then capital changes, then the markets will be really good at making some of these decisions. But I don't know, it's just, on day to day, it would be very difficult to parse, especially in a market like in 2020 where it's, it's been very difficult for people to say it's been a fundamental based price move in markets because we've had too much uncertainty really to even say that.
Well,
yeah, if I could just chime in here.
Yeah, please, go ahead.
I would really like to distinguish whether these equity markets are on the long run, doing good things, which I'm perfectly willing to believe, and what's the right way to support innovation, which I think is kind of in some sense a different question. Companies now tremendously successful, like Apple, didn't begin by being traded in, publicly traded in the equity markets. The question is, for innovation, how do we really get the resources to the creative new ideas? And so that's what I see as somewhat distinct from this notion of our equity markets doing good things, which I believe in a lot of situations and over the long haul, I think that there's lots of reason to believe they are.
And Lars, if I just want to add to what you just said, the clients that we have that have permanent capital. So let's say there's 2 ways to sort of divorce the market from short-termism. One is give a fund permanent capital, or you shield the entity from public markets by keeping it private, right? So there's 2 ways to manage that. And our clients that have essentially permanent capital, because it's either their money or it's one family's money, they've been spectacular because they can make the 20-year bets, but if someone has capital that can leave after a month, they're making 1-month decisions. And similarly, you keep a company private long enough, as long as you're not creating distortions by Peter flipping to Paul in the private market, so there's ways to get out of that short-termism.
The nature of capital matters. We have a lot of questions from the floor that are pretty pandemic focused. And let me start with one. Should government evaluate the measures that it takes to prevent the loss of life by comparing the costs, direct or indirect, to the measures with the value of lives saved? The US government has analyzed the question and places a value of roughly $125,000 for a healthy year. Do we think this kind of comparison implicitly, do we do this kind of comparison implicitly when we allow people to speed, smoke, and be obese? So the question is really around whether, whether the costs are measurable, how they're measurable, and, how we do that right now. Lars?
So implicitly, I think policymakers almost have to confront this. Is it easy to do? I think it's, economists, a lot of the initial calculations about economic policy and COVID are pretty naive take on the value of life. There's some tricky issues here because the people that are most vulnerable to COVID are people who are already quite old and people who are already in ill health, and so that makes the assessment of the value of life very, very heterogeneous, and the heterogeneity is often not really done, handled in a very smart or intelligent way because I guess it's challenging to do as well. So I think it's not a very easy measurement task, but I think it's one that's implicit in thinking about the consequences of COVID. So it's in some sense unavoidable.
Tom, how do you think about that very uncomfortable question as an investor and with investors? Because you think about demographics a lot in your work.
Yes. I mean, Jared, it's tricky because if I had to say, what do financial markets care about? Financial markets care about earned income from capital. And so the equation that would matter to them the most is, what's the way to optimize the total capital generated while dealing with a disease? And, I guess you could, in theory, say it's one of two ways. One is like shut down the economy, and if it's short enough, but you save everyone's life because no one's dying, or do you keep it open and hope you manage it in a way that is minimizing the healthcare and the human tragedy? I don't know. I mean, that's tricky because, because in the middle, because of course you can't do the extreme, and because especially in a political system where people get voted at the state and local governments if people start dying, so policymakers are going to make very local decisions. I think we're just seeing it real time today, and that the answer is both seem to be at work, and I think people are truly thinking of about the lives, but they're also, and I think we also have to recognize there's chronic disease now too. So people who catch this, this is a disease that even the way it's affecting people, I don't think it's completely understood, right? Because now they used to think it was a cytokine storm. Now they're thinking it's the Bradykin hypothesis, and then that's very scary because then it's like one of those horror movies where we just all of our vessels start leaking. So I don't.
So I this panel can go in so many deeper directions, and maybe what we'll do is we'll figure out a way to follow up. But I think we have to begin to actually contextualize a lot of what we've talked about here about uncertainty, the elements of uncertainty, and we marry that with the short and long-term situation that we see by some of the most substantial drivers of that uncertainty, namely pandemic COVID-19, future pandemics, health crises, climate change, and understanding the cyclicality of technology, for example, and as it relates to not just financial markets, but also its intersection with demographics. And so when you think of this conversation that we've had in your work, gentlemen, looking forward, what do you see as the long-term implications, very specifically right now, of COVID-19 and pandemics in the future on economic growth? Because what you've given us right now is really a masterclass on how to think about the uncertainty generated from a shock. And now the question is, we have this shock. So Lars, why don't you start that element of the conversation, please?
So this is going to be highly speculative. I don't have a crystal ball, but I wish I did. One of the things I expect that will be impacted coming out of COVID, and this is part of it's learning by doing, and part of this is going to be concerns about the potential pandemics in the future. Certain types of ways we communicate and do business, I think, will be permanently altered. Obviously, they've been temporarily altered in a very big and dramatic way, but I think there will be some permanent consequences of it. I personally like the idea of teaching students live in classrooms and not doing it online. I think something gets missed. I think spontaneous interactions can still be important. We've learned how to imitate some of those features more remotely. We've figured out how to do some of those tasks in more remote ways. And I expect that's going to carry over into a lot of business practices and a variety of economic activity, that there'll be some changes down the road in terms of how we do things. So I think there's been some learning by doing. And as I say, this pandemic is going to put on the radar screen all. Will we be in better prepared for the next one? Which means will we be better suited to make these type of adaptations? So that's going to be interesting to see how that plays out. They say, of course, I miss face-to-face interactions. I expect them to come back, but will they come back perhaps in a little bit different way and more muted ways, in some settings? It would not surprise me to see that. So in terms of the type of, I see that as one longer-term outcome coming out of this COVID type of activity, or this COVID type of experience. I guess that would be the primary one that I think about. So I'm happy to pass the baton.
Tom.
I think that 10 years from now, when we look back, we're going to look at 2020 as an episode. Meaning, I don't think in 10 years we're going to have masks and no crowds, and New Year's, Dick Clark's New Year's is not going to be on Zoom. But that episode, I think, is going to affect society the way a war would, because it affected everybody at the same time. So it's almost like the world was bombed for 12 months by a foreign, a alien space thing that just bombed, and everybody had to stay inside. And I think I think they call it hysterosis, but I don't know what you'd call it, where I think, the educational system is going to have 12 months where people have an inferior education across, kindergarten all the way to graduate school. I mean, how many science experiments can you do remotely, and MBA, and so I think you have there's 20 million people in colleges, and there's probably 30 million in primary school. So we there's gonna be a huge skill gap. So I don't know. So I think that's maybe that's the scar.
Do you see anything positive? Do you think any new skills, not necessarily that will substitute, but
I think there's a huge amount of positives, Jared, for shareholders, because every company, like if you said, okay, number one, you asked the financial market, so you're going to close the economy for 30 days. Most people would have expected the majority of S&P companies to go bankrupt, but they didn't. And at the same time, the companies got a chance to see how they really operate with fewer people. So I think operating leverage is going to be huge coming out of this, but the distributional consequences, I think they're going to need a lot fewer jobs. So I think companies are going to make a lot of money with a lot fewer people.
So Lars, you know, how much of that in your mind are policymakers really prepared for structurally? Really, you know, how much are they really thinking about, in your estimation, how much are they really thinking about that, that distributional issue, as Tom calls it?
Yeah, the question is what they can really do about it. I think that in some sense they'll pay lip service to it. I think it's a very interesting question coming out of this is, early on in the pandemic, I had a lot of confidence that our economy would be very resilient, and coming out of it, once we got a vaccine generally available across the population, that we could really restart the economies in some fairly robust ways. I still have some optimism that will happen. It'll be interesting to see how that does play out, though, of course. And the like is how prepared governments are. I think governments have been caught totally by surprise, and they're trying to get to the next few weeks, the next month or so, and they're not. And these long-term issues have been just stuck on the back burner.
Well, I mean, as I said before, we could go on to, you know, down a number of pathways, and maybe we will. Maybe we should come back and do this again and really have a conversation over time. Maybe that's one of the advantages of the virtual environment. We get to explore some pathways because we've been given a certain amount of gift of time back with these types of conversations. But unfortunately, we're at the point where we have to close. But I'd like to wrap by making a couple of observations about what you both have taught me, at least, in how to think about uncertainty. Because with all the specificity and diving in that we did, and we had more to do, obviously, I think there was a couple of lessons that I took away. I mean, first of all, uncertainty compounds. And even when you have financial markets responding in parabolic fashion for whatever reason, it doesn't necessarily decouple that compounding of that uncertainty. And therefore, the cadence of data and paying attention to the cadence of data when it comes in and how it comes in and the time scales of those uncertainties and where the mismatches are, and mapping those to cycles, economic cycles, market cycles. This is very, very critical. And I think that it demands a level of intellectual rigor and honesty from investors that perhaps were being challenged to show during this time. And maybe there'll be a sorting out because of that. But I think it's only because of having the ability or the desire to have a conversation and learn from both the most macro and the most intensive micro fields, and try to bring them together and synthesize them, that we'll be able to succeed, or at least put one foot in front of the other. And so with that, I want to thank you both, Lars Hensen and Tom Lee, for an excellent conversation. I wish you good health, stay safe to you and your families as well. Thank you all, and thank you to our audience as well.
Thank you.
Thanks.
Thank you all.